Hi, everybody. Welcome to the second segment, episode 161 of Sold with Updike Pugh. Today we have a very familiar face. It's Jeremy Radcliffe with SWBC, so welcome.
Yes, thanks for having me on. It's great to be.
Thank you for giving us your space today.
Yeah, you guys are in our space today, so welcome anytime.
The reason that I wanted to have Jeremy in today to talk was because the second home market has really changed over the last couple of years, and I think we saw in first pandemic summer of 2020, the market, second home market just exploded. People were running away.
Everybody wanted to get to a lake house and somewhere different.
Yeah, and then it slowed down a little bit in 2021, but it's still higher than it was. Percentage of the market is still higher than it was like 2017, 2018, 2019.
Yeah, and I think some of that, Jeff, has to do with partly guidelines have changed more in favor of second homes. They've gotten a little more clear. One of the things that happened in 2021 was there was a small window, it was about a 6-month window, where FHFA, which is kind of the oversight for both Fannie and Freddie, they had tacked on a pricing hit for any non-primary residence homes, so anything investment property, second homes. So rates had actually ticked up a little bit, so it maybe discouraged. That might be why we're not seeing the same figures as what we had in 2020. But we're still seeing a heavy demand. I regularly have people reach out saying, hey, what does it look like? Can we do a second home? What are the guidelines for that?
And that's all changed recently, hasn't it?
It has. We've seen some, I think for the positive, there's been some clarity on some of the guidelines. It used to be that you would have a mileage requirement. So assuming you lived in Dallas or DFW, it used to be that you had to be 60 miles away from whatever property you were looking to purchase as a second home. That's gone away because if you consider maybe someone was, they wanted to go buy a house on a lake, which maybe was only 30 miles away. Well, that was by definition a second home, but because of that mileage requirement. So that's gone away, very encouraging. It used to be that you'd have to kind of create this like destination location, like it had to be at a resort town. That's not the case anymore. There's scenarios where, and I talked to an underwriter yesterday, they just said it has to kind of make sense. It's open to dialogue in terms of why something would be considered a second home.
It's still got the sniff test to it, but it's not quite as
Correct.
long
yes,
of a
the
sniff.
test is still there, and what they're looking for is like a great example of what wouldn't be a second home is if I live in Dallas and I want to buy a second home in Dallas. Well, that's probably a investment property.
Yeah.
So that's the difference. But I'm encouraged by some of the changes, and the qualification requirements have gotten a little bit more clear too. So.
That's great. So what are some of the qualification requirements when somebody is wanting to purchase a second home?
Yeah, so you can get in as low as 10% down. So
wow.
If you're, and rates, as I mentioned, they're treated just like primary residence rates. So you could buy a home. We're still seeing low threes in those scenarios. One of the things that's been a big driver, I think, is that people are recognizing interest rates are starting to tick up, and some of the data in terms of inflation, some of what the Fed's talked about, and raising rates. So I think that's been a big motivation for people to kind of consider, hey, is now a good time for us to get into an affordable second home?
I think NAR today said because of the comments from the Federal Reserve that they're anticipating mortgage rates, even on primary, secondary residences, to be close to 4% next year.
I don't doubt it. Yeah, we're going to start seeing that tick back up a little bit. One of the things in terms of qualification, it's interesting that I talked to this underwriter yesterday, and they said they define occupancy as being 14 days out of a year. So you just have to be able to stay in that home for 14 days out of the year. It has to be in a location where, one, it's limited to one unit. So meaning you can't buy a duplex. So it can't be a 2-unit or a 4-unit property. You could buy one side of a duplex. You could buy a condo, a townhome in a different location, but it is limited to 1 unit. It has to be suitable for year-round occupancy. So I was trying to think like what would that actually mean? And I guess maybe locations where weather wouldn't allow you to. Maybe in Alaska or something like that. Somewhere like that where you couldn't have access to the property. And the other thing is the borrower has to have exclusive control of the property, meaning they can't have some sort of agreement with a management company that would say, hey, you're not allowed to be in these weeks or months.
It almost kind of rolls toward timeshare.
Correct. Yeah. Feeling. So it would be similar to like a timeshare. It's not a timeshare. It can't, by definition, be a rental property. However, it doesn't mean that we are seeing people have short-term rentals when they're not using the property, and there's nothing that would preclude that. So you
So-
just can't use that rental income for qualifying purposes. So
Big difference
yeah,
there.
big difference. And then outside of that, I mean, I think and we'll kind of go through qualifying ratios of how that works, but I think it's a great opportunity for people to get into a second home, and I think it's another tool that people could use for building wealth. If you consider what's going on, at least in our area, appreciation values year over year could be a great way to capture some of that savings and that appreciation.
Absolutely. What are some of the examples of people that you've worked with that have?
Yeah, I love some of these stories that have come by. We had a homeowner in McKinney. They lived in McKinney, had a great house up there, but they worked downtown Dallas. And so they were like, can we get a condo in downtown and I'll just stay there during the week and then go back home on the weekends? And it absolutely worked. And it probably raised their quality of life too, not having to drive. We talked about the gas mileage. We've got grandparents, some good friends of mine, grandparents. They live in California. They've got young kids here grandkids here in Dallas. And they bought a second home to have a place to come visit and stay and see the kids more frequently. We had parents in Florida. These are just examples. There's tons of them. Parents in Florida whose kids go to SMU. They wanted to be able to come in, go to some of the games, spend time with them. And so they've got a condo not far away from here. And then one of my favorites is there was a couple who loved going to Fredericksburg, Texas. They were there often. They like the wine country out there. And they found a home in Fredericksburg, and we were able to make it work as a second home. So
That's great.
yeah.
So what would you recommend someone do if they are well, let's jump back one. So from a qualifying perspective, what would give us a scenario that might?
Yeah, so
works?
it's basically like we look at any primary residence, or we're treating it the same. You just have to assume you've got credit, assuming you've got the assets to qualify. Then we're doing the debt to income ratios, which we've talked about a lot on your show. And looking at this example, so let's assume someone's got gross monthly income. I'm just using this example, $8,000 a year. If they have a current housing payment, which includes everything, homeowners insurance, taxes, insurance, any HOA dues, let's say that's at $2,000 a month. Taking any other monthly debt they have, credit card debt, any car payments, any student loans, let's put that at $500 for our scenario. And then if they're trying to buy a second home, all of that PITI payment again, let's say that comes out at $1,500. You could go as high as $4,000 in your monthly debt. Divided by that $8,000 gross monthly income, you're at a 50% debt to income ratio. As long as the automated underwriting system approves it, which takes into account reserves, credit, all those things. But from a qualifying ratio, you fit. So it's the same as a primary residence.
So about 50% overall.
Yep.
Your minimum payments on all of your debt over here has to be 50% or less of your gross monthly income on the other side.
That's correct. And anytime we're looking at that 50% ratio, we try to, on our pre-approvals, say, hey, this might be more property specific. Just make sure we have all the info. But I mean, it's pretty cut and dry. And what I would recommend, I think you allude to it, is when you're considering, hey, does this scenario work for a second home? It's a great idea to talk to a loan officer. We can kind of run those, we vet a lot of those scenarios and we kind of chat through. And then we could tell you, hey, this probably doesn't pass a sniff test based on what you're telling me, or it absolutely does. So
cool.
Yeah.
So if you are considering a second home, reach out to us. Certainly reach out to Jeremy. We'll have his contact information below, and find out if it is something that you have a need, desire, and interest in. So
yeah, I think it's a great idea. Go for it.
So thanks for joining us today. I really do appreciate it.
Thanks, Jeff. Thanks for coming out.